So today I'm here to talk to you about private capital markets and M&A. And so I guess I thought we'd start with perhaps what everybody expected in 2015 at the beginning of 15. So this is a composite of two different surveys, one by KPMG, one by Deloitte, of people that do M&A deals on the buy side, but largely private equity, but also corporate buyers as well. So in general, going into 15, everybody thought this would be a terrific year, and it has been. It's been another strong year thus far, and we'll talk about that a bit more. One thing that I think is interesting is that you notice the number of people that expected to either divest a business, if they're or part of a business if they're a corporation, or perhaps exit a portfolio company as a private equity group. And that number increased from 14 to 15. And I think when you see people that buy and sell companies for a living, looking at taking advantage of the market that we're in and selling, being more likely to sell a business than not, I think that does tell you something. And we saw that same dynamic in 2007. Interestingly, lots of focus on foreign acquisitions, which isn't unusual by corporate buyers, but is highly unusual by private equity buyers. And the three biggest, most frequently cited countries were Canada, the UK, and China in terms of looking at geographic expansion. In terms of industry, both surveys pointed to three sectors. They were in different orders, but it was energy, healthcare, and technology. And I think really for different reasons. I think the change in healthcare market because of Obamacare, I think created a belief that there would be opportunity in that dislocation, in that changing market. And so there's been a lot of people that have been focused on that sector. Technology is growing, it's influencing our lives in more and more ways every day. Energy, I think the take on energy was that a lot of people saw what happened late last year and said, this is a good entry point for me to get into energy. I know that we started having private equity buyers who historically had not been investors in any sector of energy come through our office and start talking to us about using this as an entry point into the market. They had missed the last cycle and wanted to use this as an entry point and expected really to be making meaningful investments kind of in 6 to 9 months, so right about now. Well, I think that if you asked them today, they'd still probably say that they mean to make those investments in 6 to 9 months, because I think by and large, that entry point, I don't think people feel like there's been quite enough pain in the marketplace yet. So real quickly, if you look at kind of what size deals people are focused on, it edged up a little bit in terms of kind of 250 to 500 million, making a big increase relative to last year. But still, generally, the lower middle market is seen as an attractive place to be. And if you asked people why M&A activity would be strong this year, 65% of the reasons that people cite really have to do with capital availability. I think another important thing is there is earnings growth, and if you look at a lot of the private companies versus the S&P 500 or the S&P 600, what you see in that dark blue line is that generally private companies have outpaced the growth that you see in the larger businesses, and so there's a lot of I think there's people are looking for growth, and that's one of the primary determinants ultimately of return on investment. And so we've seen that the M&A activity in the private sector be quite robust because of that growth and the capital availability. So this chart just gives you a sense as to quarterly activity in terms of deals closed between 100 million and 500 million going back to 2008. You can see that the world changed and from our perspective ended briefly in September of 08, and deal volume went to essentially nothing in 2009. Remember that when we get to a chart down the road, because it's going to look like 2009 and this other chart was good, but recall that there was no volume, and we'll touch on that in a bit. If you look in the first half of 2015, what you see is really, other than 14, it's the strongest period that we've had, strongest start to the year that we've had since the recovery. So as we sit today, we're in the 6th year of what I would call an up or a strong, active M&A market. This is just very quickly, a representation of GullStar's backlog. We're here, we're in the market. We've got a concentration of deals that are probably 2/3 located here in Houston. And so I put this up only to give you some perspective in terms of our level of activity. If you were to update that last bar for this week's meeting, which we didn't have the benefit of when we did this slide, you'd see a couple of deals that flipped up into the in documentation in the closing sector. A couple deals were added and one fell off in terms of because it closed on Friday. People ask us, well, what's been the impact of the energy change that we've seen? And I guess I would probably point to that dark blue line, or dark blue part of the chart at the bottom, and you see a slight uptick, about 4 or 5 deals that are in that category relative to, say, September of last year. And those are really probably our upstream, drilling-oriented oilfield service companies that are in what we call extended. We put things in extended for a variety of reasons, but those deals have gotten hung up, okay, in terms of really they don't, their earnings are dropping considerably. So everybody talks about the amount of capital that's out there to deploy, and that being one of the primary drivers of what's driven things and created kind of a strong M&A market. And I agree with that. That's a contributor, no doubt. If you look at this chart, this gives you the funds that have been raised by private equity firms by size of firm in each of the last several years. The gray in the back is really the what we call the overhang or the capital overhang. It's committed capital that hasn't yet been invested. And I think one observation that is readily available is you can say, well, there's always been more than enough capital to close the deals. So I think it's a contributor to kind of activity, but I don't think it's really driving valuation. You look at the S&P 500, you look at the amount of cash that they've got collectively on its balance sheet. And really, this last quarter was the first time in 7 quarters that we've had a downtick in that amount of cash, but still the S&P 500 is quite liquid. And so again, strategic buyers also have a lot of cash out there. So what is it that drives values? Well, one is earnings, and one's capital availability, primarily in our opinion on the debt side. So if you look at the chart on the left, you can see that these deals are primarily typically funded, irrespective of size, and it varies a little bit, but roughly 50% equity and 50% debt, kind of where that gray shading in the back lies. And you can also see on the chart on the right that there is typically a size premium. So you look by deal size. 10 to 25 is generally going to trade at a lower multiple than, say, a 100 to 250 value. And so when you look at the overall deal, you really need, at the overall market, you really need to understand what portion of the market you're looking at from a data perspective. And so what I mean specifically by debt driving value is that ultimately private equity groups they're in business to do deals. I mean, they're trying to deploy capital out into attractive opportunities, and they're competing with one another, and they're competing with corporate buyers alike. Everybody says, well, certainly a strategic buyer is likely to outpay a private equity group, and we don't have time to go into it today, but suffice it to say, in the last 8 years, our experience is that about 60% of the time, the corporate buyers are actually outbid by the financial buyers. Now, that's not true in each year, but in the aggregate, that's the case. And so I think one of the reasons for that is that they will pay what they can pay. And so, if you assume for a moment that a deal's funded half with equity and half with debt, if on day one you can borrow 3 times leverage for that against that business, and you put another 3 times equity, in to do that deal, you can pay 6 times, everything else being equal. If the next day you can borrow 4 times, well, then you can afford to pay 8 times. And we try and make sure that people do. But if you look here, in the first half of 15, you can see leverage multiples overall. Now, this does not distinguish by size. So this is 100 to 250, or 10 to 250 million in aggregate value. But you can see leverage multiples here in the first half of 15 have edged up. I'm going to kind of get right through these slides here pretty quickly, given time. But I guess a couple of things that I would just point out on this slide. You can see in that bottom portion of the chart that you can see that premium for size. Okay, now this would actually point to the fact that the total debt to EBITDA for companies for the M&A market has actually throttled back a little bit, in the first half of this year, and I think part of that is coming from the fact that people are, what you're seeing private equity groups over-equitize a lot of companies because prices have gotten pretty high. And so that's contributing a bit to it. And then what you see as you move up the spectrum in terms of size, less than 10 million, above 10 million, but less than 25 million, and above 25 million, you see that total leverage multiple edge up. If we were to take this and go to, say, 50 million in EBITDA, what you would see is really another turn, probably up to 6 times total leverage. Another dynamic that you see in today's market is that the banks have pulled back. And this probably started in our market, the middle market, about 18 months ago. And they've pulled back a bit, not necessarily in their posture in terms of wanting to do deals, but they've been outbid in a number of instances, in an increasing number of instances, by non-bank senior lenders that are not facing the same regulatory issues that banks are when it comes to highly leveraged loans. And so what we've seen is a real shift in who's providing the capital on the debt side of the balance sheet. Interestingly, that's also where we were in 2007, especially the latter half of 2007. The banks had pulled back because of the mortgage crisis. That void was filled by hedge funds and CLOs, and we're kind of in that same spot now, right? So we need capital markets. We need to keep the capital markets flow into those business development companies that are publicly traded that do senior debt, and make sure that the market stays liquid. If you look at kind of where we are from a covenant trend, you can see big increase in covenant-light deals relative to recent history. So this gives you a quick snapshot as to where we are relative for a given size deal. In this example, this is the dashed line is the median valuation back to 2003 before for each size company. So one is the dark blue line is 10 to 25 million. The lighter blue line is 25 to 50. And you can see that right now we're above. We're actually above kind of the historical average. I think in reality, we're a little bit further above than it appears because a lot of that second quarter data is not yet reported, and it takes a bit for the companies that aggregate this data to compile it. And so that data will continue to change as we get deeper into the year. I can tell you from our perspective, we don't see any difference in the first quarter and the second quarter. So that downturn, I don't actually believe it. 7.3 gives you the kind of historical multiple for 100 to 250 million size deals, just for a point of reference. So what does that premium mean? Well, what it means is that right now you can do, if you assume that there's probably a 1 to a 1.5 times multiple premium for a given company in today's market, you can actually do a recap with a private equity group that ultimately gives you more cash up front, and you still own about 25% of the business. And so, how does that happen? Well, if you say, okay, today's value is 7 times. If you take and you run through that, and you say, okay, well, look, today I can get, if you got a $23 million business, you sell it at 7 times, you can sell that business for about $160 million. You'd have to reinvest $20 million, as part of the recap. but you'd still own 25% for that $20 million, and you do that tax deferred. And you compare that, so take off, say, a turn and a quarter off of that 7 multiple, and say, okay, at another point in time, we'd sell that same business for 5.75 times, and let's say you sold 100% of it to a strategic buyer. Well, that would give you $130 million, and so you compare the two, and so in one case, you've got $20 million, you've got, $8.5 million more in cash, and you still own a quarter of the business, and you've gotten a lot of liquidity out of the company. And so I think that's one of the reasons that we see a lot of business owners, ultimately select, the private equity route. This gives you a sense as to kind of volatility over time in terms of purchase multiples and leverage multiples. And a couple of just quick observations. One, if you look back over time, and we have taken this back, 40 years, you see that the market tends to move in kind of 4 to 6 year periods, followed by 18 to 24 months of downtime, and so right now we're in the 6th year of a strong market. Remember 2009 here looks like it's a good market, but there was no deal volume. So the companies that got done in 2009 were companies that did not have a downturn in their performance, and so people paid up for those. So that's the disconnect between this chart and that other deal volume chart. If you look out to the right, we're not actually predicting a downturn. This is a placeholder for a discussion with clients, and so at some point this is going to come. We'll have a downturn, and things will correct, as Drew's pointed out, in the public markets. So when you think about, well, should I do something with my business now or should I wait? The answer depends on what your time frame is. If your time frame is 10 years, then this possible dip doesn't matter. If your time frame is 2 to 3 years and you're kind of thinking about it, well, then we probably need to do some work and think about how this might impact you one way or the other. And so with that, and then I'll stop, we've got a couple of different tools to help people think about that. And so this is an example of how somebody might go about thinking about, should I do something now or should I wait? If you look at that horizontal shading, you can see that was a value that we thought that a guy could sell his business for today when we did this. That dark blue line is the implied value if the market stays exactly the same for over a period of time. And so you can get a sense as to, if he waited, is he going to sell it for dramatically above the range or the same amount of money as he could today? Or is there going to be, perhaps, does he risk having a downturn in the market? And so to quantify that, we said, okay, look, what happens if he misses his numbers? And you can see that light gray line is what happens if he misses his numbers, but the market stays the same. That darker gray line is he hits his numbers, but we have a 1 multiple turn decrease in EBITDA pricing over that time period. And so what does it take to have a 1 multiple turn EBITDA pricing over that time period? It takes a half a turn decrease in leverage. And that's going to turn into a full multiple because you fund it 50% with equity, 50% with debt. And then the yellow line is what happens if both of those events happen. And so this analysis is going to be different for different companies. This is a different business with different growth trajectory. This is yet a different business with a different growth trajectory. And so, but these are some of the types of things that you might think about, as you think, should I do something now or should I wait?